If you do not hold too much public accounting, why are you disclosing too much? But generally, now rule is very clear. So two major update for cash flow, everything else remains same, no worries. Businesses, companies were not showing detail of operating expenses on the face of P&L. Now they want on the face of P&L, not on the notes of accounts. Administration expenses, selling expenses, distribution expenses, or by nature. Nature simply means type. Hello students, I welcome you all. I'm your friend, mentor, ACCA CMA Mohit Agarwal. So what we are going to discuss today. So as you can see, there are certain recent changes in our FR and SBR due to two prominent standard IFRS 18 and IFRS 19. And these changes are applicable from September 2025. So in this short video, I have simplified, summarized all the changes. So without any delay, let's discuss the changes. First and foremost, all of you, that IFRS 18 has replaced IS1. Are you aware what was IS1? So IS1 talks about how financial statement is presented, how P&L is prepared, the format of P&L, format of balance sheet. Now, my friend, it is replaced by IFRS 18. Although all major things remain same, but there are certain few clarifications or changes which we will discuss in few minutes. Then we have a small new accounting standard IFRS 19, which talks about subsidiaries which are not listed. We will talk about it. Okay, so let's discuss first what changes IFRS 18 has brought in. So IFRS 18 first tell us that P&L, see P&L should have following subheading. Now these heading has become mandatory. Previously in IS1, these heading were not mandatory. There were no clear definition of operating profit and losses. Now IFRS 18 has given clear definition that operating profit losses should only include core business activities. Operating activities do not include investing and financing, and hence they have made compulsory that in a P&L there should be one heading called operating profit and loss, and other heading will be profit loss before finance and income tax. So these two heading now become compulsory. I agree, some of you must be thinking that sir, company were already preparing their annual reports in this format. Yes, they were, but at that time these heading were optional, but now they have made mandatory. The objective behind this is this has effect of dividing the profit loss into three clear sections. Now they want the division to be clear. Operating, like in cash flow, they want P&L to be clearly segregated in operating, investing and financing. Obviously, if you show operating profit loss separately, all operating incomes will be separate. Then you are showing profit loss before finance and income tax. So all the investment income will come before profit loss, before finance and income tax, like rental income, dividend income, interest income. And from that, you will minus your financing outflows, interest paid, etc. So this is a basic format. They are talking about revenue minus cost of sale, GP, operating expenses. Now, IFRS 18 has also brought some changes in IFRS 18 also, in operating expenses also. So then there will be operating profit. From operating profit, you will add any investment income, then profit before finance and tax. You will minus finance cost, then PBT. So these two headings, operating profit and profit before finance and tax, is ensuring that P&L is aligned with the objective of dividing P&L into three core activities of operating, investing and financing, and now they are mandatory. So is this a major change? Obviously not, just a clarification. Okay. Now, second important thing this talks about is operating expense must be on the face of P&L. So IFRS 18 is saying that you cannot hide operating cost expenses in notes to accounts anymore. Previously, businesses, companies were not showing detail of operating expenses on the face of P&L. Now they want on the face of P&L, not on the notes of accounts. You want to show in notes of accounts, it's okay, but it should be also on the face of the P&L. Face, on the face it should be there, and can be present expense in two ways. It says you can present expenses in two ways, by function and by nature. Sir, what's the difference between a function and nature? So first thing is you cannot hide them in the notes. You have to show in the face of the P&L. And secondly, showing by function or showing by nature. Function means reason of expense. Why such expense has incurred. You may show operating expense due to their reasoning of incurrence. For example, administration expenses, selling expenses, distribution expenses, or by nature. Nature simply means type. So nature, my friend, simply means type. What is the type of expense? Now, you can obviously understand type will be more clear if we compare it with the function, because in function you are giving major broad heading, but in nature you are explaining each type of expense, staff cost, rent, depreciation. That's why our accounting standard says that if you're using function based, give more breakdown in the notes. So you have to give more detail in the notes. Obviously, when you are saying that we have clubbed admin expenses, so what were the admin expenses, you have to give the detail in notes to accounts. So this is a major update, but again, a presentation update, again, a more clarification, more transparency approach by IFRS 18. One more major update, my students, for cash flow. See, there are two major updates in cash flow. Everything else is same. So if you remember, in indirect method, when we prepare cash flow, previously we start with net profit or profit before tax. Now accounting standard has clearly said that cash flow will start from operating profit, means you will now directly take operating profit, add back depreciation, other changes, working capital changes. So they have removed all this extra work of taking profit before tax, adding income tax, interest, etc. They want you to take operating profit as a starting point for cash flow under indirect method. So one major update, that you have to take operating profit. And secondly, there is again a very good clarification given by accounting standard. Previously, this was also missing. Now, accounting standard says that if you receive interest, if you receive dividend, it will go to investing activity. Now, interest and dividend have specified fixed places. Previously, these places were not fixed, all of you. Now, accounting standard has fixed these places, and it says that if there is any interest received, if there is a dividend received, it will go to investing activity. And if you pay interest or dividend, it will go to financing activity. So clear identification, clear bifurcation is there, that if there is any interest or dividend income, it will go to investing activity, and payment is financing activity. No more debate, except if obviously if your core business operation is earning interest, if you're a banking, etc., then it will go to operating activity. It is obvious. But generally, now rule is very clear. So two major update for cash flow. Everything else remains same. No worries, student, that sir, IFRS 18 has brought major updates. No, there are no major updates. These are just clarifications. First, you have to start with operating profit. Instead of using profit before tax, etc., now start with an terminology given by IFRS 18, which is operating profit. Doesn't make much difference. Secondly, the clarification regarding the treatment of interest and dividend, which many students were earlier confused now. Sir, where to show interest, where to show dividend? Now you have a solution. Good change, right? Again, a presentation change. Goodwill. At the time of consolidation, we calculate goodwill, consideration paid plus NCI minus net asset on date of acquisition. So it says the goodwill calculated now need to be shown separately. You cannot club with other intangibles. So generally what we were doing earlier now, we were clubbing goodwill under the heading intangible without showing it separately. But now it need a separate presentation. Very important. But again, a clarification, more like a clarification, does not make much difference in our life. On a consolidated statement, financial position goodwill must be displayed as a distinct line item. So we will show. What is the issue? If they want, we will fulfill. Understood? One more thing. See, are you aware about disclosure notes? Notes to account? Obviously, yes. Now, previously, there were many items where companies write like other income, other as asset, other expenses without giving breakup or details of the same. Now here IFRS 18 strongly discourages that. Do not use these words, these vague words. They do not give any clarity. What do you mean by other income? What do you mean by other asset? So even in our classes, we sometimes have discussion on these aspects, that these types of words are very vague and now accounting standards are really getting up to it. They are understanding that these vague words bring um, manipulation, brings uh, uh, less clarity in the mind of stakeholders, shareholder. So to bring more transparency, they have introduced these words like they have removed the words like other income, other asset, other expense. It says that if there is a rental income, clearly say rental income, do not say other income. If there is any prepaid rent, means you have an asset, prepaid rent. So clearly say prepaid rent, do not say other asset specifically in your disclosure notes. So clear headings help stakeholder understand what exactly being reported. So you will know now exactly what is getting reported. Yes, sir. Now, this specifically this amendment is for SBR. Till now, whatever we were discussing, my friends, is applicable both for FR and SBR. But this specific amendment is only for SBR students. So FR students need not to worry about MPM. This is not in your course. This MPM amendment is specifically for FR. Although till now, whatever amendment I have discussed, do you think they are very painful? It is very easy for both FR and SBR student. They can all manage with these amendments. They are not even amendments here or major changes. These are just clarification in the terms of presentation. They're bringing more see, understand the objective. The previously IS1 were not very strict about the presentations of such items. Now IFRS 18 has given clarity and strictness that how should you present following things. If we talk about it again, if I give you a quick summary, it simply says that operating profit loss is a mandatory figure in the P&L. You have to show profit loss before finance and income tax also mandatory now. Then operating expenses should be shown on the face of P&L. You cannot hide in notes to accounts. Cash flow, two major update. Start from operating profit, and second major update is very simple. Interest, if there is any interest income, dividend income goes to investing activity. And it's very logical also. And any payment will go to financing activity. Understood, sir. Goodwill should be shown separately. Do not use word other. Obviously, words like this are not very clear. There is an ambiguity. There is some vagueness in these words. Right, sir. Now, they have introduced this special amendment for SBR, management performance measure. Okay, first understand what is this MPM. See, there is a topic in SBR, alternative performance measure. So similar to that topic, this is MPM, similar to APM, alternative performance measure. Basically, what is MPM? MPM is a separate reporting. MPM is a separate reporting by the company to give certain clarity, certain emphasis on certain figures. They develop their own tools, they develop their own items to give more clarity to the user, to give them more focus of their performance to the user. So it says IFRS 18 introduced MPMs, specific subtotals in the P&L. So this is introduced by IFRS 18. Now IFRS 18 is also regulating the earlier unregulated areas like APM. So they are trying to regulate their public communication also. IFRS 18 is regulating what they will show in financial statement, but what they are showing in their other statements like publication, public communication, external communication, investor calls, press release, uh, there also IFRS 18 want to regulate it. It says that what makes a major in MPM must be a subtotal in P&L used in external communication, not mandated by IFRS but voluntary added by the company. So what they are saying that MPM is basically a subtotal of the figures already in the P&L. They are used generally for external communication and they are not required by IFRS. They are voluntary presented by the company themselves. Sir, why companies is providing additional measures, additional MPMs? To show their performance with more clarity, to emphasize on certain areas. For example, see, understand, let me give you one example. Let's say my operating profit is 10 CR, but there is one-off item, one-off item. There is one-off item. Let's say The value of one-off item is 2 CR. There is a one-off expense which will not occur on a regular basis. It is a one-off item. And this operating profit is 10 crore, but I want to show my performance before this one-off item, because due to this one-off item, my operating profit must have reduced. So company want to show operating profit before one-off item, operating profit before one-off item. So it will be 12 crore. Now this 12 CR is a MPM, understand. Your operating profit was 10 crore, but in your operating profit, there was a one-off item. In your operating profit, there was a one-off item amounting 2 crore. Now, shareholders who want to understand that what was core operating earning capacity of the company, they may need these MPMs to get better clarity. So in such cases, company voluntarily providing their investors that in reality, we have made a profit of 12 crore, not 10 crore. There was one-off item. This expense will not reoccur in the future. Hence, you should consider our profit as a 12 crore, not 10 crore. Now, what IFRS 18 has to say on this, it says it's okay. You are showing MPM, we are allowing you to show MPM. We are not here to discourage you from showing MPM, but we are here to regulate MPM. It says operating profit first. What is MPM and what is not MPM? That is also very important. Accounting standard clearly says operating profit. Showing operating profit is not a MPM. You cannot show operating profit as MPM because operating profit is the figure given by us. It is the figure required already in the IFRS. How can you say it is an additional measure? It's a voluntary measure given by you. It's a measure which is mandatorily given by us. It's not by you. So operating profit cannot be a MPM. Average wage paid. Now this is also not an MPM. Understand, very important point. Why average wage paid is not an MPM? Because this figure do not come in PNL. See, to become an MPM now, there is two conditions. One is MPM measure should not be a measure which is already required by IFRS, like gross profit, operating profit, profit before finance and income tax. These type of measure are already reported or required by IFRS. So you cannot call these measures as MPM. And second important, to become an MPM, it should be a subtotal of figures already reported in PNL. Now, average wage paid is a statistical figure. It's not a subtotal. Basically, how will you get average? Just by adding certain items from the P&L. Obviously, you cannot. So, average wage paid is not a subtotal, and that's why it's also not an MPM. So, MPM have two qualifications. MPM have to pass two tests. One is it should not be required by IFRS. It should be something different. And secondly, it should be a subtotal of already given figures in the P&L. Understood? Understood, sir. Operating profit before restructuring cost. Now, restructuring cost is a one-off item. You do not restructure every year, and hence it's an MPM, because operating profit before restructuring cost is a different item, unique item, voluntary given by the company, and secondly, it is a subtotal. You added two figure and you got it. EBITDA, earning before interest, tax, depreciation, amortization. Now, this figure is also adjusted EBITDA, adjusted operating profit. All these are, my friend, MPM. Although these figures are not required by IFRS, these are unique figure company has developed for giving better clarity to the user. But now IFRS 18 even replaced EBITDA, or given suggestion that instead of EBITDA, use term OPDAI. They have introduced a term OPDAI. A huge recommendation, because EBITDA is a very famous term in valuation, etc. But accounting standard is very clear. Accounting standard says, please align things as we are reporting in the P&L. Do not use different words. It may create confusion in the mind of user. It says OPDAI. OPDAI is simply operating profit before depreciation, amortization, and impairment. Although it is similar, but the using these terminology make it aligned with the P&L terminology. So EBITDA is, I think, now will be called more like OPDI. Understood? We will talk a little bit more later on. I have some slides on it. So, okay. Now, accounting standard have no problem. You can show your MPM if you fulfill above condition, but you have to understand that there are some requirements. One is, what are the requirements, sir? Clearly explained. What is the use of the user? So, 4 requirement of IFRS. Now, whatever MPM you have to set the 4 condition. Reconcile that MPM with IFRS major. So like you do na bank reconciliation, cash book with passbook. So your major should reconcile. You should have a separate presentation of reconciling your major within a IFRS major. For example, operating profit before restructuring cost should be reconciled with operating profit, gross profit, whatever it is. So reconciliation should be there. Disclose in notes with a statement not necessarily comparable with other company MPM. Obviously, MPM, every company's MPM may be different. My MPM is adjusted EBITDA, your MPM is other EBITDA, your MPM is operating profit before restructuring. So you cannot compare MPM and tell this to the user of financial statement that MPM may not be comparable, because every company has voluntarily developed. There is no set rules for MPM. So it may not be comparable. Clearly explain the use of MPM. Secondly, reconcile with the already established benchmark. And finally, audited. Now, very important. This is very new. Previously, there was not such requirement, but now it says must be reviewed by auditor just like other IFRS disclosure. Very good. And this I was talking about EBITDA and OPDI. IFRS preferred by IFRS like the OPDI. So kya kare? IFRS 18 OPDI operating profit before depreciation, amortization, impairment instead of loosely defined EBITDA. So this ensure consistency across company. So I think this one is a major recommendation by accounting standard, but totally acceptable. I totally agree. So these were some basic changes with IFRS 18. Major changes. So is it something big? Obviously no, yeah. Many students were asking me, sir, can we use our existing material? Obviously, yes. The amount of changes I have covered in these notes are sufficient. You can use your existing material along with these notes, along with this short video. Just remember these few points. See, there is no calculation point added, my friend. If we talk about operating profit presentation, presentation in cash flow, goodwill presentation, everything is presentation. Even in MPM, they are saying, just specifically saying that what qualifies MPM and what things you have to consider once you have shown an MPM. It should be, a meaning should be disclosed, audited, etc. Now, finally, the last hot topic, last confusion in my students' mind. Most of students are thinking there are some major updates in SBR. No worries, there are simple updates, simple clarification. Now there is IFRS 19, and it's a very small thing. Basically, IFRS 19 says, but it is saying that if you are a subsidiary which is not listed or which do not have public debt, if you are not a listed company, means you are a small company, then you need to do less disclosure. Then, so IFRS 19 is not an additional burden on you. It is reducing the existing burden, my friend. This amendment is helping you, not increasing your work. It is decreasing your work, my students. It says that a small companies, subsidiaries which are not listed, since their parents is doing everything, they are following full accounting standard, they are reporting fully, these subsidiaries do not require high level of disclosure. Now they can reduce their disclosures. So their disclosures are now reduced to support them, to save time, money for these small companies. This is what IFRS 19 brings for you. So is it too difficult to digest? Obviously not, my friend. IFRS 19 is a new standard that helps subsidiaries not listed on stock exchange prepare simpler financial statement. Who can use a subsidiary is not publicly listed, does not hold public money, has parent prepare full IFRS consolidated account. So very simple. On which subsidiary it is applicable for you? Just remember, it is again, it's mainly applicable for SBR, but you can take this point for FR also. So it is not publicly listed, do not hold public money, applicable from Jan 27, and this also optional By if you want to follow this accounting standard, you can. If you want to decrease your work, if you do not want to decrease your work, you want to give full disclosure, give it. So what does it do? Use full IFRS recognition measurement presentation. Okay. Although IFRS, see, it reduces disclosure. It do not reduce the applicability of IFRS. Full IFRS still need to be applied. But with reduced disclosure, no need to give all detailed notes that require in full IFRS. Example, no need to give detailed breakdown of financial instrument, can skip many risk disclosures, still need to disclose things like related party list. So some of the disclosure has reduced. No need to venture too much in it. Just remember this point. And this IFRS 19 come with an objective to save time and cost. No need to keep two set of accounts, one for the group, one for the local. Now they have reduced this burden of keeping two set of accounts, lot of disclosure, ideal for companies whose main user is parent. Obviously, the companies whose reports are mainly used by parent does not need too much public accountability. If you do not hold too much public accountability, why are you disclosing too much? Why are you posting too much? No need. If you do not have followers, if you have followers, only then you can brag about it, right? So thank you all of you. These were some major FR changes for you. I have gone through in very much detail. I hope this will support you, gives you more clarity. So Tata for today. Thank you. Bye bye.